Hello students, this is Professor Vicente Saga. Welcome to my class. This is part 1 of chapter 16 presentation. Chapter 16, Dilutive Securities and Earnings per Share. As you already know, the objective of this course is threefold. Number one, we are to understand the accounting principles of the relevant topic and also learn how to apply those principles. Number two, based on our understanding of those principles, we then prepare the underlying financial statements and the related disclosures according to generally accepted accounting principles. Then, three, we analyze and interpret the financial statements. Now, the underlying financial statement here obviously is the balance sheet with a connection with the income statement. Now, in the previous chapter, this is what we have accomplished thus far. In balance sheet, in chapter 13, we zero in on current liabilities. In chapter 13, we talk about the accounting principles, their applications, and how to apply those principles in preparing the balance sheet, specifically the current liability. Then in chapter 14, we zero in on long-term liabilities. Then in chapter, that is in chapter 14. In chapter 15, we shifted gear and we zero in on the stockholders' equity section of the balance sheet. Now in chapter 16, we are going to talk about part of stockholders' equity section of the balance sheet and EPS, that is earnings per share, which is related to the income statement, another financial statement. So that is basically the overview of chapter 16, or a part overview of chapter 16. Now, to that end, in chapter 16, we are going to zero in on learning the accounting principles relative to the two main issues on hand, how to apply the accounting principles to enable us prepare a complete, accurate balance sheet in accordance with GAAP, and also how to analyze and interpret the balance sheet. Now, that being said, let us take a look at the structure of this chapter. Like I just indicated, the chapter deals with two issues: dilutive securities and earnings per share. And the chapter is further divided into three sessions: dilutive securities, accounting for stock compensation, and computing earnings per share. So that is the structure of this chapter. Now let's take a look at the objectives of this chapter specifically. So we are going to talk about the accounting for issuance, conversion, or retirement of convertible securities. We are going to talk about convertible preferred stock. Talk about stock warrants, issued with other securities. We're also going to talk about stock compensation plans under GAAP. We are going to briefly talk about the controversy involving stock compensation plans. Then we talk about how to compute EPS in a simple and a complex capital structure environment. So moving along, let's take a look at the further overview of this chapter. As I indicated earlier, the chapter deals with two main issues: dilutive securities and earnings per share. So let us briefly talk about earnings per share. So the question is, what is earnings per share? We said that it is the earning that the company earn for each share of his company stock. So what does that mean? Now, first of all, I just want you to know that the earnings per share is perhaps one of the most popular, if not the most popular, company's performance measure. What does that mean? The question is, how do we know how well a company performs? If you want to make that determination, there are different things that we look at, but the most popular and the one that is widely used in the business industry is earnings per share. So it is the most popular performance measure of a company's profitability or performance. Now, the question is, how do we compute earnings per share? Before we get into all the details, in a very simple, in its simplest form, we say that the earnings per share can be calculated as net income divided by the number of outstanding common stock. So that is earnings per share. So we are going to talk a little bit about the interpretation of this equation in a minute. So now, how does that work? Let's take a look at a couple of two different companies. Let's assume that we have these two companies in the same industry, company A and company B. Now, the net income or the net profit of company A, let's assume is 100,000, and the net income of company B is $1 million. So the question is, ordinarily, if I ask you which of these two companies would you be interested in investing in as a potential investors? So one company generated or earned $100,000 in a net income or profit, company B $1 million. Ordinarily, you'll be tempted to say that you are more inclined to invest in companies B because from the outset it looks as if company B made more profits than company A. But then further examination might reveal otherwise. Let's take a look at the EPS of both companies. Let's assume that company A has 100,000 shares of outstanding common stock, and the company B has 2 million shares outstanding at the end of the year. So if you do the math, clearly the EPS of company A is $1 and the EPS of company B is 50 cents. So what does that mean? That means for company A was able to earn $1 for every share that the investor or the owner owns. So if you have a company A stock, for every share that you have, the company was able to generate or make or earn $1 for you. But let's take a look at B. The EPS is 50 cents, meaning that company B was able to earn or make 50 cents for every one share that you own. So clearly, obviously, company A performs better than company B. But if you look at the income statement of itself, you will be tempted to believe that company A performs better than company A because company B has $1 million profit and company A only $100,000. Now, so bottom line is, why is the EPS important? Because it is a common denominator. When we compare the net income of company A and company B, we were comparing apples to oranges. But when we compare the EPS of company A versus company B, now we are actually comparing apples to apples. So that is basically what EPS is all about. Earnings per share, a very popular performance measure of a company because, again, like I said, it is a common denominator for every company. So that being said, let us take a look at the second issue relative to chapter 16, that is dilutive securities. Now, what does that mean? What does that mean? Now, let's take a look at Oops, I should not have gotten rid of that. But nevertheless, what is dilutive securities? Remember, we just talked about EPS as earnings per share. We said that any security that have the potential to dilute or reduce EPS is a dilutive security. So what does that mean? Let's take a look at the examples that we just went through. We said that to compute EPS in its simplest form, we said it is net income divided by the number of outstanding common stock. So the net income here is $100,000, and the number of outstanding common stock is also 100,000 shares. So $100,000 versus 100,000 shares. So the EPS is $1. So meaning that for every one share that you have of this company, the company is able to make or generate $1 for you. But that does not mean that you are going to receive $1. Whatever, so even though the company generated $100,000 in profit, they can choose to declare less than that. So whatever profit or dividend that is declared by the company, we call that a dividend per share. That is what you actually receive. And right here from the outset, we are talking about earnings per share. How much does the company earn for you for one share? So let's take a look at what we have here. Let's assume that the company has another type of financial security, for example, convertible bond. What does that mean? We talked about that extensively in chapter 14. We said that a convertible bond is a bond that can be converted to common stock by the bondholder. So if you have convertible bond and the convertible bond is likely to be converted to common stock, we call that a dilutive security, meaning if those bonds are converted to common stock, they have the potential to dilute or to decrease earnings per share. So let's back up. What is dilutive? My favorite example is, for some people, if you drink a coffee and the coffee is so strong, how do you dilute it? For some people, they will put more cream or some water, or some people will do combination of both, more water, more cream, more sugar to actually dilute the coffee. So here we are talking about dilutive securities. So those are securities that have the potential to dilute earnings per share, EPS. So let's take a look at an example here. Let's assume that the company, in addition to having 100,000 outstanding common, in addition to having 100,000 shares of outstanding common stock at the end of the year, let's assume that the company also have a convertible bond that can be converted to 100,000 that can be converted to 100,000 shares of common stock. I said that can be converted. It's not converted. So our assumption here is if the convertible bonds are converted to common stock, then the denominator, instead of 100,000, would be 200,000 shares. That is if converted. So from that standpoint, take a look at EPS is no longer $1 if those bonds are converted into common stock. Rather, the EPS will now be 50 cents. So the convertible bond have the potential to dilute or to decrease EPS. Why is that important? That is important because the potential investor might be interested in knowing whether there are some securities out there that have the potential to dilute or decrease EPS. So that is the essence of why we are zeroing in on dilutive securities in relationship to earnings per share. So we use part one of this presentation to talk about the overview of this chapter, and we are going to use other parts to zero in on the details. So this will be the conclusion of part 1 of chapter 16 presentation.